To practice what we've learned so far, we will now book 10 journal entries. These entries will reflect 10 business transactions that took place within a new hypothetical small business. There is a young, ambitious entrepreneur, and he decides to open a new company. We will call this company Hypothetical Consulting Firm. Let's take a look at the business transactions that will take place next, and the journal entries that will be used to record those transactions. A company needs capital in order to operate. So the first thing our business owner did was he invested $4,500 into his new business. We need to come up with a journal entry to record this. Let's analyze this transaction so we can properly record our entry through debits and credits. And let's approach this as follows. Ask yourself a question. What did the business receive? Well, the business received cash. Cash is an asset. It's something that a business owns. And in our situation, it has increased as a result of this transaction. Now ask yourself a question. Do we record an increase in cash with a debit or a credit? If you don't remember, that's fine. We're doing this to learn and practice. To help us understand, let's go back to our illustration of the accounting equation. It shows us that assets increase with a debit. So that's the way we'll record an increase in cash. We'll debit cash for $4,500. Now we know that within any journal entry, there should be at least one debit and one credit, and the total of all debits must equal the total of all credits. We have determined what the debit should be in this entry. So the next question we should ask is, what's our credit? Let's think about it. As a result of this transaction, the company's cash position has increased. So the question to ask is, who provided this cash? Well, this cash was provided by the owner of the company. So the owner's interest in the business has also increased as a result of this investment. And as we've learned a little earlier in accounting, the owner's interest in the business is represented by the owner's equity account. So the other account that should be increased is owner's equity. And then the question becomes, should we debit or credit owner's equity within this entry? Now we know it's going to be a credit, because we were looking for an offset to a debit. But since our purpose is to learn and practice, let's ignore that fact and evaluate this scenario the proper way by looking at our accounting equation illustration. In our situation, we have an investment by owner, which increased the owner's equity in the business. Looking at our illustration, we can clearly see that equity accounts increase with a credit, so we'll need to credit an owner's equity account. We'll credit an account called Owner Contributions for $4,500. Owner Contributions is an owner's equity type account. So again, to record this transaction, we'll debit cash for $4,500, as increases in assets are recorded with a debit. And we'll credit owner's equity for $4,500, as increases in owner's equity are recorded with a credit. And here is how our journal entry will look. Let's take a moment and point out a few things regarding this journal entry. It's important for every entry to have a date. In accounting, everything is driven by date. As you'll see later, these entries make their way to the financial statements. And when you run financial statements, they are always based on dates. So for the financials to reflect accurate data, it's critical for every entry to reflect a correct date. Our debit is recorded on the left side of the entry, as to debit something literally means to record it on the left side. Both the name of the account and the amount are recorded to the left. Our credit is recorded on the right side of the entry. Also, every entry should reflect a memo that provides explanation on the transaction that's being recorded. In our case, we're recording an investment by owner, so that would be our memo. Finally, we need to post this journal entry to respective T accounts. As you may remember from a previous lesson, T accounts accumulate all the debits and credits that pertain to a particular account over a specific time period. They are a great tool for analysis of your entries. So we'll post a debit to cash for $4,500, and we'll post a credit to owner's contributions for $4,500. The balances within the T accounts will accumulate, as we'll post more entries, and will show us the detail of the balance of each account. Let's move on to the next transaction. The next transaction that took place is that the business owner signed a lease for office rent and processed a payment of $4,000 to the landlord. This payment comprised of a $2,000 security deposit and $2,000 payment for current month rent. Let's analyze this transaction so we can come up with a journal entry. This $4,000 that was paid by the business. What exactly was this for? Well, it was for two things. Of the total payment, $2,000 went towards a security deposit. A security deposit is an asset. Assuming the office is in good condition, it's expected to be repaid back to the tenant at the end of the lease term. Assets increase with a debit. So we'll debit a security deposit account for $2,000. Notice that this debit is only for $2,000, whereas the payment was made for $4,000. Obviously, we'll need one more debit to account for the other portion of the payment. The other $2,000 was paid for current month rent. That's an expense, and expenses increase with a debit. So we'll debit rent expense for $2,000. Our total debits now equal $4,000. Then we'll look at what the business gave up in exchange for getting this security deposit and 1 month rent. The business paid $4,000 cash. Cash is an asset, and assets decrease with a credit. So we'll credit cash for $4,000. So, here is our journal entry to record this transaction. We'll debit security deposit for $2,000. We'll debit rent expense for $2,000. And we'll credit cash for $4,000. Finally, we need to post this journal entry to respective T accounts. After posting this journal entry to T accounts, we can see that we only have $500 of cash left. This can present serious constraints on the ability of our business to operate. As such, we have to look into additional methods of financing as soon as possible. Next, this company purchased computer equipment with total cost of $1,800. This equipment was purchased on credit, with terms of 30 days. Let's analyze this transaction. When a business makes a purchase, in order to account for it properly, a decision has to be made on whether this is an expense or an asset. The main criteria in making this decision is whether this item is expected to be used up within the next accounting cycle. Usually that means within the next year. If it will be used up within the next year, then it's an expense. However, if it's expected to benefit the business for a number of years, then it's an asset. Computer equipment is not something that is expected, get completely used up within the next year. As such, it's not an expense. It's an asset that will benefit our business for a number of years. Assets increase with a debit. So we'll debit computer equipment for $1,800. Keep in mind that we didn't pay for this purchase with cash. Rather, we bought this on credit with terms of 30 days. When you purchase items on credit, a liability account called accounts payable will increase. Liabilities increase with a credit, so we'll credit accounts payable for $1,800. To record this transaction, we'll debit computer equipment for $1,800, as increases in assets are recorded with a debit. And we'll credit accounts payable for $1,800, as increases in liabilities are recorded with a credit. Finally, we need to post this journal entry to respective T accounts. Let's move on to the next entry. Next, our company purchased office supplies for cash. Total cost of supplies is $370. Let's analyze this transaction. Office supplies are reasonably expected to be used up within the next accounting cycle. So this purchase is an expense. Expenses increase with a debit. So we'll debit office supplies expense for $370. We paid for these supplies in cash. Cash is an asset, and assets are decreased with a credit. So we'll credit cash for $370. So here is our journal entry. Debit office supplies for $370 and credit cash for $370. The only thing left to do is to post this entry to the T accounts. Here is what that will look like. As mentioned before, T accounts are a great tool for analysis because they enable us to monitor the balances of our accounts. For example, the T account for cash clearly illustrates that after 3 transactions that pertain to this account, our balance of cash has been depleted to the point where there is only $130 left. This should alert the business owner that he must raise more cash immediately. This is why it's so important to monitor and analyze your account balances. Next, our company purchased various professional publications on a credit card. Total of this purchase was $1,270. We will expense this to professional materials. An expense is increased with a debit. So we'll debit professional materials expense for $1,270. Next, we should ask ourselves a question. How did we pay for these professional materials? Well, we put it on a credit card. Credit cards, payable is a liability account, and liabilities increase with a credit. So we'll credit cards, payable for $1,270. And here is our journal entry. We'll debit professional materials for $1,270, and we'll credit cards payable for $1,270. Finally, we need to post our entry to the T accounts, and we're all done with this entry. As mentioned previously, our company is running low on cash, and our business owner made a decision to take a $5,000 loan from a bank. Let's analyze and record this transaction. What did the business receive? Well, the business received $5,000 in cash. Cash is an asset, and assets increase with a debit. So we'll debit cash for $5,000. In return for receiving this cash, the business took on an obligation to repay it back to the bank in the future. This is a liability. The account for this liability is called loans payable. Liabilities increase with a credit, so we'll credit loans payable for $5,000. And here's our journal entry. Debit cash for $5,000 and credit loans payable for $5,000. Make sure to post this entry to the T accounts. Here is what that will look like. Looking at our cash T account, we can see that after taking out this loan, our company has a healthy balance of cash and enough liquidity to continue business operations in the short term. Next, we purchased office furniture on credit with terms of 30 days. Total purchase was $2,700. Let's analyze this. Office furniture is definitely something that we expect to use for several years. So it's an asset. Assets increase with a debit. So we'll debit furniture and fixtures account for $2,700. This furniture was purchased on credit with terms of 30 days. When a business purchases things on credit with terms to repay at a later time, this increases an account called accounts payable. Accounts payable is a liability, and liabilities increase with a credit. So we'll credit account payable for $2,700. And here's our journal entry. Debit furniture and fixtures for $2,700. And credit accounts payable for $2,700. Make sure to post this entry to the T accounts. Here's what that will look like. And we're all set with this entry. The next event that took place in our business was that we performed some consulting projects for our clients. After the work was completed, we generated and sent out several invoices for a total of $5,000 for consulting work performed. Let's analyze this transaction. When a business issues an invoice to their customer, there is an increase in an account called accounts receivable. Accounts receivable is an asset, and assets increase with a debit, so we'll debit accounts receivable. What about the other side of the entry? Before we answer that question, we need to review something very important that we learned in one of the previous lessons, as it applies to our current situation. There are two methods of accounting, cash and accrual. Under the cash method of accounting, you recognize income when you receive cash from your customer. However, under the accrual method of accounting, you recognize income when it's earned. Under the accrual method, the point at which you'll receive cash payment from your customer is irrelevant. Income is earned when the work has been performed. Since our business uses an accrual basis of accounting, the other side of the entry is to recognize income for the work that's been performed. Income increases with a credit, so we'll credit consulting income for $5,000. And here is our journal entry. Debit accounts receivable for $5,000 and credit consulting income for $5,000. All that's left to do is to post our entry to appropriate T accounts, and we're all set. Next, we paid a $1,800 bill, which was already reflected in our accounting system. This bill is for computer equipment that we purchased on credit earlier in the month. Let's look at this transaction and make sense of what is happening. When this bill was originally received and entered into our system, we credited accounts payable, because our liability increased at that time. Now that we're paying this bill off, our accounts payable will decrease. Accounts payable is a liability, and liabilities decrease with a debit. So we'll debit accounts payable for $1,800. What about the other side of the entry? Well, we're making a payment for this bill, so our cash will decrease. Cash is an asset, and assets decrease with a credit. So we'll credit cash for $1,800, and here is our journal entry. Debit accounts payable for $1,800 and credit cash for $1,800. Make sure to post this entry to the T accounts. As you can see from the T account for cash, while our cash balance is still healthy, it did decrease substantially as a result of this latest transaction. As such, we should monitor the balance in this account closely as more transactions are booked. Next, we received a $1,000 payment from a client on one of our outstanding consulting invoices. Since we received a payment, our cash balance will increase. Cash is an asset, and assets increase with a debit, so we'll debit cash for $1,000. Since our client made a payment, they no longer owe that money to us. This will decrease our accounts receivable associated with that client. Accounts receivable is an asset, and assets decrease with a credit. So, we'll credit accounts receivable for $1,000. And here is our journal entry. Debit cash for $1,000 and credit accounts receivable for $1,000. Make sure to post this entry to the T accounts. This was journal entry number 10, which is the final entry in this presentation. Hopefully, going through these examples has improved your understanding of how to book entries. This concludes our introduction to journal entries.